it's time for the editor's cut, and we talk about two interesting topics. One cautionary and one maybe not so. Actually, both of them cautionary, right, Alex?
So you have to tell me, and of course Vishy is joining in as well, the banking editor. But let me give you a sense of what this is all about if you're tuning in for the first time. Editor's Cut. We take a couple of big stories or three big stories and we try and delve into them and give you the perspective that is in the newsroom so that you can approach the day of trade with a lot more confidence and hopefully usable insight or actionable insight. The conversation today is about two aspects. One has to do with the latest financial stability report from the Reserve Bank of India, where you're getting a bit of an inkling as to what was running through the regulators' minds when it came in very assertively to stop or to reduce unsecured lending or to put curbs on unsecured lending. Vishy is going to tell you all about that. And we're also going to talk about the renewable energy space and what is buzzing. Of course, we know that that's a theme that has been playing out. But what is the outlook for the next financial year based on some of the information that Neeraj has picked up and compiled? So let's start with the FSR, which is a significant statement by the Reserve Bank of India to make.
Yeah. So, Alex, the FSR is it's a 6-monthly, half-yearly statement that the RBI puts out on the strength of the banking system and what the future looks like, right? In that, they also look at what has happened in the past and sort of explain why. But this is probably the first time that since November 16th, when the RBI came out against unsecured loans with a rule to increase the risk weights on those loans, the first time since then the RBI has given a clear indication of what is it that was worrying them. Previously, the RBI governor said we are not waiting till the house catches on fire and all that. But now we understand what exactly, who's lighting the match, so to say. So a few points that the FSR points out specifically as potential risks, and that's the first one is with regard to the risk profile of personal loans as well as consumption loans. No, the loans themselves. Right. So what the situation looks like is that there have been more downgrades on those loans than there have been upgrades in terms of the risk potential of that particular loan. That indicates that there is some level of stress that is building up.
So just to, sorry, before you step forward so that everybody understands, when you're saying downgrades of the loans, it means that there is delay in payment and therefore the bank is categorized?
Not necessarily delay in payment, but the situation around the loan is looking like, for example, the income has not increased too much, the person's borrowed maybe too many loans. All of that will come a little later. We'll try and understand where all of those fears are coming from. The second thing that the RBI has noted is the high vintage of these loans. Now, what is high vintage? Typically, the vintage refers to any loan which has turned into NPA 12 months after it has been borrowed, right? So that for personal loans stands at 8.2%. 8.2% of the personal loans that have been borrowed in the banking system are turning NPA within the first 12 months, which is a very high number, and that's something that obviously is concerning the RBI.
Red flag.
It's a big red flag, yes. The other point that the RBI is also talking about is with regard to the over-leveraging, which I said, it's not necessarily just default, it's also the situation with the borrowers. So according to the RBI's assessment, and they're looking at credit bureau data, they're looking at bank information, 43% odd of the borrowers who have taken a consumption loan. A consumption loan is basically you take a loan to buy a car or an air conditioner or a fridge, right? You take these loans. So anybody who's taken a consumption loan, 43% nearly of those customers already have 3 live loan accounts. So this is their 4th loan by the time they take it. And not to forget that more than 30% of people who take these consumption loans have taken loans, at least 3 loans in the last 6 months. So it's not just the current point in time, it's also very recent history that people are just bulking up on loans. And then there's the last point that they made was that 7.5% roughly of people who, of borrowers who take loans under 50,000, they have at least one default on their portfolio.
So wow, okay. So that's very significant.
That's a very significant point of stress. Now, obviously, in terms of absolute numbers, these don't add up because these are very, very small figures, right? In terms of the banking system loans above 150 lakh crore. So this is going to be a very small percentage of that. The problem is more on the direction in which it is headed, right? So if you're a retail borrower who's so far been the bedrock of retail growth in India, right? Over the last 10 years, housing, vehicle loans, they've all pushed up retail loan growth. In the last 2 to 3 years, unsecured lending has really boosted retail loan growth. So if those borrowers are facing some amount of stress, over leveraging or default, that's a serious cause of concern, and that's why the RBI is saying that maybe there's a need to rebalance the risk weights on these loans and make sure that banks are not over-leveraging or over-extending the loans to these borrowers. There is some limitation on that.
I have a question here, and actually, and by the way, a comment that I don't remember who, but one of the MNC brokerages, somebody was making this point that a lot of people who are taking 75% of their home loan, around 75% of the total value as home loan, are taking another 25% via personal loans for home improvement as well.
Right.
So even there, the personal loans might be going.
So I spoke to somebody at the RBI, and the point that they were making is that as long as it's within housing, they're actually not that bothered.
But here's my question, Vishy. If you're taking a loan for home improvement, so on, that's not money going in a small ticket consumption item like a phone, but a larger thing, and therefore...
so basically on the house, there is no borrower equity. They are not putting up any money of their own.
Right. And therefore, sorry, one more question from my end, therefore. That was just a point that I heard somebody, so I thought I'll bring it up.
Sure.
But the question that I have is there a risk of increased NPAs in certain lenders, and people have to, of course, do their research, in certain lenders who might... whose lending practices may not be completely strong, and who are borrowing at the lower end, because I saw that statistic that you mentioned, that under 50,000 there is at least one default.
Yeah, that's right. So definitely there are lenders who have a weaker underwriting standard. Those are words that the RBI has used in the FSR, saying that this is indicating weaker underwriting standards. The high vintage, as I told you, 8.5% roughly of personal loans, seeing some amount of stress, over leveraging, that's pointing to weak underwriting standards. But obviously this is not an industry-wide phenomenon. It's in certain pockets. Which are those pockets? Who are responsible for that? We'll figure out.
But then to go to your original point, clearly a match had been lit, which is why the RBI stepped in to extinguish it.
Absolutely, that's what's happening.
But one last point before we move on to the next subject, which is the stress test that the RBI conducts. My initial reaction to that was positive, I must admit, because we've seen days when the banking system non-performing assets had ballooned and reached unprecedented levels, and we're talking about 3.2% as of September of this year, and a worst case severe stress scenario would push it to what, 4.4% in September next year. Isn't that a positive thing?
Let's look at how the RBI conducts these stress tests. There are three buckets in which they put it. Baseline scenario, which is the current economic conditions continue for the next 1 year. A medium stress scenario where the current economic conditions deviate by a point of 1, and a stressed scenario which is 1.25. Now the current conditions are so congenial, things are looking really good. In a baseline scenario, 3.2%, which is 2% gross NPA that is there currently, will be about 3.1% in September next year. So things are pretty much flat on the gross NPA front. Now, even if from the current congenial conditions things deviate slightly, it's not really that bad a situation. So part of it is, of course, we knew about it. The other part is the RBI sort of reaffirming that view, that in the future, things don't look that terrible.
All right. So that was, anyway. So I'm not completely off in my expectations. The situation is congenial right now. All right. Neeraj, the second point, which has to do with a couple of these renewable energy players or players in the space that have seen their valuations go very substantially higher in 2023 for good reason. The question that you're asking is FY25, the outlook, justifying that valuation?
Yeah, so, and the jump that is anticipated, and, wind power is one, solar is one. We've seen Adani Green do that PPA as well, right? So here's the piece. And the thing is, are the valuations prohibitive? That's the question that we are asking, right? So wind and solar, the big picture, there's a 50 gigawatt annual renewable energy bid process, which will be for the period of FY24 to 28. That's large, okay? I mean, current wind is hardly, Suzlon and Inox put together have an order book of 3 gigs. That's about it. So if you're talking of 50 gigs or 50 gigawatts for the next 5 years, that's 10 gigawatt an annum. You can imagine the difference in size, right? Now, there is a declaration of the trajectory of wind RPO up to 2030 by the Government of India. First offshore wind tender expected to be floated soon. and NTPC's one tender is out there as well. And wind capacity or solar capacity is getting added at a good space, but the targets are very, very high. So therefore, the question you ask is, are markets pricing in growth from these companies for the foreseeable future already? Remember, Adani, on its annual report, as Sajid was saying, talks of targets of 45 gigawatts by 2030. When we spoke to Inox Wind day before yesterday or the day before that, they spoke about how they have executed 200 megawatts in the first half. They'll do 500 megawatts in the year at large. They will do 650 megawatts FY25. And they didn't shy away from saying that we might touch 1 gigawatt as well in FY26. So these are very stiff numbers that people are talking about. The NTPC wind solar power tender, which got declared on December 27, saw some very strong bidding. So, and none of the listed players, completely unlisted players, but saw very strong bidding. The NTPC wind tender is open, could be very meaningful for Inox Wind and Suzlon. And we all know that Adani Green recently tied up for that 1799 megawatt of the SECI order as well. And last piece, the guidance is looking very strong. I already mentioned some of the numbers there. Suzlon has guided for doubling of dispatches in the second half versus the first half. And there is a company called Sangvi Movers, which transports these turbines, right? You look at ancillaries as well. Sangvi Movers guided to 45% growth in H2 over H1. So nearly 1.5 times of what they did in H1 is what they will do in H2. And we know the Adani Green things, I don't get into that. But just the point that some of these businesses are guiding to some very, very, very strong business growth over the next 2-3 years.
What are the multiples looking like though, Neeraj?
That's the only problem. And you can call it a problem if you look at FY24, Alex and Vishy, but maybe not at FY25. I'll make this very quick. Inox Wind trades at over 300 times FY24. But it comes down to 25 times FY25. And by the way, this is 25 times based on the earlier guidance. In the interview, he said that they might up the guidance for FY25 in the fourth quarter. Suzlon, and we haven't spoken to them recently, it trades at over 80 times FY24, 33 times FY25. So I think maybe the answer is, how well can some of these companies execute? And if they can, then the valuations become palatable. Otherwise, they look very, very stretched at the current numbers.